I think it will continue, but likely attenuated. If you look at the CME futures market, they're predicting only about a little over 20% increase out to 2018. I think that's a reasonable forecast. It also corresponds to the forecast I got from a survey of home buyers who said, that was last May, and it said that they were expecting 4% a year for the next 10 years. So those are reasonable forecasts, I think, right now. Well, in our research on the wealth effect from housing, we find that the housing wealth effect is even stronger than the stock market wealth effect. That's because it's dispersed among so many people. Everyone, not everyone, but a large fraction of the population owns a house. So this should have an impact, a positive impact on the economy. Mortgage rates have gone up a lot since a year ago. And that's another reason to think that there will likely be a slowing in home price increases in the coming year. But I still think they'll be up in the coming year.
Yeah, the Fed definitely wants out. I think when Hilsenrath put that in the paper last week in the Wall Street Journal, that was pretty much fait accompli. Fed's going to go $10 billion this meeting, probably $10 billion the next meeting. And I think it's starting to affect the markets. As you move out the risk curve, because that's what the Fed wants, they buy bonds so that we don't have to push everybody out the risk curve. What's the end of the risk curve? Emerging markets. Where are all the problems starting to come? Emerging markets. Why in the last few weeks? Because the market's starting to realize Fed's serious. They're going to go $10 billion every meeting, and that's where it starts. It starts at the riskiest assets, emerging markets.
I expect that the Fed's not going to say anything. It's going to hold the $10 billion withdrawal the way it is. I don't think at the moment, based on what we've seen the last couple of days, as well as even today's macroeconomic report is very weak, that the Fed is going to up the ante right now. I think they're going to let Janet Yellen take control of the reins and watch it for another month before they start withdrawing again. If they do, though, I would expect that the market's going to break down and test the 1765 level and find some real support there. And then I think there'll be some real bargain hunting and some longer-term opportunities for people.
So I think this was pretty much in line with my expectations, even after December 18th, when the RBI decided to stay pat on rate hikes. I made the point to a lot of our investors that there are three clear sets of reasons as to why rate hikes will have to be administered, and in no way this is the peak policy rate. I think definitely that added as an incremental factor. Like I said, the other two factors, which is basically the structural nature of inflation and the need to give savers a positive real rate of return, was the primary driver. But incrementally, ever since you have seen this emerging market sell-off come through, especially since Friday, I think that really made it very, very clear to the central bank that it didn't have the luxury of pushing through calibrated rate hikes, and they had to move very, very quickly.